Welcome to my YouTube channel. Today we discuss, what if I told you there is a financial crisis hiding in plain sight, one that has been building for 6 straight years, one that the mainstream financial media has almost completely ignored, and one that may be the single most important structural story in any commodity market right now. Here are the numbers. Since 2021, the world has consumed more silver than it has produced every single year, for 6 consecutive years in a row. The cumulative shortfall over those 6 years is approximately 815 million ounces of silver. That is roughly equivalent to an entire year of global mine production, simply gone. Removed from vaults, consumed by industry, absorbed by investors, and not replaced. COMEX registered silver inventories, the metal available for immediate delivery on the world's largest silver futures exchange, have fallen by over 70% from their 2020 peak. The LBMA in London, the heart of the global wholesale silver market, has seen vaults drain by approximately 87%. In Shanghai, 56% of available silver disappeared from exchange vaults in just 51 calendar days in late 2025. And silver lease rates, the cost of borrowing physical silver for short-term delivery, surged from a normal 0.3% all the way to 8% annualized in January 2026. That kind of move in lease rates doesn't happen in a healthy, well-supplied market. It happens when physical silver is genuinely, acutely scarce. Today we are going deep on the story that most mainstream investors have no idea about. The 6-year silver supply deficit that is quietly reshaping this market from the ground up. Section 1. How we got here. The deficit timeline. To understand the scale of what's happening, you need to see the data year by year, because the numbers tell a story that is truly extraordinary. Let's go back to 2020. In that year, the silver market was actually in surplus. Global supply, mine production plus recycling, was approximately 976 million ounces. Total demand was around 900 million ounces, a surplus of about 76 million ounces. Inventories were healthy. COMEX registered silver stood at 346 million ounces, a near record high. The market was comfortable. Then 2021 happened. Industrial demand accelerated sharply, driven primarily by the first major wave of solar panel build-out and electric vehicle production ramp-ups. Total demand jumped to over 1,049 million ounces, a massive leap. Supply didn't keep pace. The market swung from a comfortable surplus to a deficit of approximately 51 million ounces. That was year 1 of the deficit. In 2022, the deficit exploded. Total demand reached a record 1.242 billion ounces, driven by the fastest growth in industrial silver fabrication ever recorded. Supply again failed to keep up. The deficit ballooned to 211 million ounces, the largest single-year shortfall in the modern history of the silver market. In 2023, demand eased slightly but remained elevated at 1.195 billion ounces. The deficit narrowed to approximately 142 million ounces, but it was still the 3rd consecutive year of shortfall. In 2024, total demand came in at 1.16 billion ounces, with industrial demand reaching a new all-time record of 680 million ounces. Global supply was approximately 1.013 billion ounces. Deficit, 149 million ounces, the 4th straight year. The Silver Institute confirmed that the cumulative deficit from 2021 through 2024 alone had reached 678 million ounces, equivalent to 10 full months of global mine supply. In 2025, the 5th consecutive deficit arrived, estimated at approximately 95 million ounces, bringing the cumulative 5-year total to approximately 820 million ounces. And now, in 2026, the Silver Institute and Metals Focus have confirmed a 6th consecutive year of deficit, projected at 67 million ounces, even as total supply reaches its highest level in a decade at 1.05 billion ounces. 6 years, 815 million ounces removed from above-ground stocks, and barely anyone in the mainstream financial world is paying attention. Silver supply versus demand, year-by-year deficit table, 2020 to 2026. Year demand, MOS, supply, MOS, deficit, MOS, average price. 2020, 900,976, surplus plus $76, $20.55. 2021, 1,049, $1,000 night and 51 Maz, $25.14. 2022, 1,242, 1,031, 211, Mos, $21.73. 2023, 1,195, 1,000, 142, Mos, $23.35. 2024, 1,160, 1,013, 149, Mos, $28.30. 2025, 1,200, 1,007, 95, Mos, Est, $80 plus average. 2026, 1,200, 1,050, 67 Mos, FCST, $93 plus now. Total, 2021 to 26, 815 Mos. Section 2. Why supply can't keep up. The structural lock. 4 to 7. You might ask, if silver is in deficit and the price has gone from $30 to over $100 per ounce, why doesn't someone just mine more? This is the single most important structural question in the silver market, and the answer is what makes the deficit potentially permanent rather than temporary. The answer lies in how silver is actually produced. Approximately 70 to 75% of all silver mined in the world comes as a byproduct of mining other metals, primarily copper, zinc, lead, and gold. Less than 30% comes from primary silver mines, where silver is the main target. What this means in practice is that silver production responds to copper prices, to zinc prices, to gold prices, not primarily to silver's own price. When silver prices rise dramatically, mining companies cannot simply decide to produce more silver. They can only increase silver output by expanding base metal operations, which requires their own independent economic justification, their own independent financing, and their own independent timeline. And mine development timelines in the modern era are brutal. From initial discovery to first production at a new large-scale silver mine takes anywhere from 7 to 10 years, due to permitting, environmental review, infrastructure development, and financing. That means decisions made today to develop new mines will not produce meaningful silver supply until 2033 at the earliest. Global mine production peaked around 2016 and has since declined by approximately 7% despite dramatically higher silver prices. All-in sustaining costs for primary silver producers now exceed $28 to $30 per ounce. The byproduct nature of most silver production, combined with the long lead times for new primary mines and the structural decline from peak 2016 production, creates what analysts describe as fundamental supply inelasticity, meaning the supply simply cannot respond quickly to price signals, no matter how high prices go. This is not a situation that will resolve itself in months. It will take years, and in the meantime, the deficit continues. Section 3. The demand revolution that won't stop. While supply is structurally constrained, demand is being driven by forces that are not just growing, they are accelerating, and they are almost entirely price insensitive. Industrial demand for silver hit a record 680 million ounces in 2024, and now represents approximately 50 to 60% of total annual silver consumption. And the key insight is this. Most of this industrial demand is what economists call inelastic. Companies building solar panels, electric vehicles, AI data centers, and 5G networks need silver. Not because it's cheap, because there is no adequate substitute. Silver has the highest electrical conductivity of any element on the periodic table. For solar cells, electrical contacts, semiconductor components, and medical devices, silver's conductivity is not a preference. It is a requirement. Solar panel manufacturing alone consumed 244 million ounces of silver in 2024, more than double what solar consumed just 4 years earlier in 2020. Global solar installation capacity is not slowing down. It is accelerating. Electric vehicles use approximately 2 to 3 times more silver than conventional internal combustion engine vehicles. Global EV penetration is still in early innings. Most forecasts put it at 10 to 15% of vehicle sales globally, with targets of 50% or more by 2035. The growth runway is enormous. Artificial intelligence and data centers represent an entirely new demand source. Chip manufacturing, high-density printed circuit boards, and advanced cooling systems all require silver. Tech companies including Samsung are already moving to secure dedicated silver supply directly from mines, bypassing exchanges entirely. In October 2025, Samsung C&T finalized a deal giving it exclusive rights to 100% of output from a restarting Mexican silver mine. This kind of direct vertical integration is what companies do when they are genuinely worried about future supply availability. Medical applications have grown 8% annually since 2020. Silver's antimicrobial properties are irreplaceable for wound care, surgical instruments, and medical device coatings. Complete silver substitution has been achieved in less than 5% of applications over the past 30 years. The combination of all these demand streams, solar, EVs, AI, 5G, medical, creates what analysts are calling a structural supercycle in silver demand that has no historical precedent. Section 4. The vault drain. Physical evidence of crisis. The most alarming and underreported aspect of the silver deficit story is not the abstract supply-demand math. It is the physical evidence showing up in real-time vault data. COMEX registered silver, the metal available for actual physical delivery on the world's largest silver futures exchange, has fallen from a peak of 346 million ounces in March 2020 to approximately 85 to 103 million ounces in early 2026. A decline of over 70% in less than 6 years. And the drainage rate is accelerating. COMEX registered silver fell from 167 million ounces in October 2025 to 103 million ounces by February 2026, a 38% decline in just 4 months, at a rate of approximately 785,000 ounces per day. In January 2026, COMEX physical silver deliveries totaled 49.4 million ounces, 4.17 times January 2025's level, and 7.27 times January 2024's level. In February 2026, the delivery rate hit an almost unbelievable 98%, meaning 98% of open contracts on the exchange were standing for physical delivery rather than rolling forward. In a normal functioning futures market, most contracts roll forward. A 98% delivery rate is not a normal futures market. It is a physical allocation mechanism. The LBMA in London tells a similar story. Available silver stocks in London vaults have dropped by approximately 87% from peak levels, leaving approximately 155 million ounces, against a global annual demand running at over 1.2 billion ounces. That's less than 2 months of annual demand in the entire London wholesale system. In Shanghai, in just 51 calendar days between late September and mid-November 2025, combined silver vault holdings fell by 56%, 21.5 million troy ounces removed as prices were actually declining. When physical withdrawal rates accelerate as prices fall, that is the signature of a genuine physical shortage, not speculative behavior. Industrial stockpiles that historically maintained 90 to 120 days of consumption buffer have been drawn down to just 30 to 45 days. The U.S. government's national defense stockpile sold its last silver holdings in 2019. There is no government buffer left. Silver lease rates surged from their historical 0.3 to 0.5% range to 8% annualized by January 2026. The futures market also entered backwardation, a condition where nearby contracts become more expensive than later-dated contracts, signaling that silver available for immediate delivery is worth more than silver promised months from now, because the market doesn't trust there will be enough available. Global silver inventory collapse. Exchange by exchange, exchange peak inventory current, 2026, % decline. COMEX registered 346, MOs, March 2020, 85 to 103 MOs, 70%. LBMA London Vaults, 1,200 MOs, 2021, 155 MOs, 87%. Shanghai, SHFE, SGE, 1,190 MOs, September 2025, 519 MOs, November 2025, 56% in 51 days. Industrial stockpiles, 90 to 120 days buffer, 30 to 45 days buffer, 60% buffer. U.S. Governor's stockpile, 100s of MOs, historic, 0, sold 2019, 100%. Section 5. What this means for price. So what does all of this mean for silver's price? And what happens when the vaults run dry? The Silver Institute's 2026 forecast projects a 67 million ounce deficit this year, even as total supply reaches a decade high of 1.05 billion ounces. The deficit is shrinking, but it is not closing. And critically, the global silver market will continue to rely on the drawdown of above-ground bullion inventories to bridge the gap between supply and demand. But above-ground inventories are not infinite. They have been depleting for 6 consecutive years. At current drainage rates, accessible exchange-held silver could face severe stress within the next 12 to 24 months, particularly if industrial demand accelerates, China's export restrictions persist, and investment demand continues its projected 20% increase in 2026. The price implications are significant. Goldman Sachs projects silver averaging $85 to $100 in 2026. Bank of America sees silver above $100. Citigroup's $150 target is explicitly tied to what they describe as an acute shortage of physical silver for immediate industrial delivery. The scenario that most mainstream investors have not priced in is not a gradual supply tightening. It is a non-linear price discovery event. The moment when the paper futures market, which currently sets the silver price based on financial flows and speculative positioning, becomes overwhelmed by physical delivery demands from industrial users who genuinely need metal and cannot substitute away from it. When that moment comes, the price of silver will not be determined by hedge fund positioning or algorithmic trading. It will be determined by what industrial manufacturers are willing to pay to keep their solar factories, EV assembly lines, and data centers running. And unlike a financial investor who can simply accept cash settlement, an industrial manufacturer cannot run a solar cell production line on a cash settlement notice. Here is the bottom line. 6 consecutive years. 815 million ounces removed from global above-ground silver stocks. COMEX inventories down 70%. LBMA vaults down 87%. Shanghai losing 56% of available silver in 51 days. Industrial demand growing faster than mine production can possibly respond. A 7 to 10-year mine development lag that means no new supply can arrive quickly, regardless of price. These are not projections or forecasts. These are verified, data-confirmed facts from the Silver Institute, Metals Focus, COMEX delivery data, LBMA vault reports, and the Shanghai Gold Exchange. The silver supply deficit is not a story about speculation or market manipulation. It is a story about the fundamental mismatch between the world's need for silver and the world's ability to produce it. That mismatch is 6 years old, 800 million ounces deep, and showing no signs of structural resolution. Whether silver reaches $100, $150, or beyond depends on how that mismatch evolves, and on forces ranging from the pace of the green energy transition to geopolitical dynamics in China. But the foundation of the bull case for silver is not momentum or sentiment. It is math. And right now, the math is the most compelling it has been in the history of this market. If this breakdown opened your eyes to the silver story, hit like, subscribe for weekly precious metals updates, and drop your question in the comments. I answer every single one. See you in the next one.